Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Can everyone see my screen and hear me? All right, thanks, Rob. Let's go ahead and get started. I like starting on this larger degree view because it gives us a much bigger perspective of the larger degree. But actually, I think going to the really, really larger degree helps even more because the previous page just showed how this primary degree wave 5 off of the March 2020 lows looks very complete. That's only part of the story that doesn't show that all the way from back here in February or March of 2009, we have a primary 1, 2, 3, 4, 5 that looks very complete as our cycle wave 5 off of this big expanded flat for the cycle wave 4 that goes all the way back to the dot-com peak. And that 3, 4, and 5 potentially completes all of our super cycle degree wave 3, which started all the way back in the 1930s at the low following the 1929 crash and the Great Depression. So the correction that we are due for is of a corresponding magnitude by Elliott wave degree to that 1929, 1930s Great Depression. So I've been talking about it as the Great Recession. Now, one of the things that we talk about in Elliott wave is that there is a guideline. It's not a rule. Rules are, there's a couple of rules in Elliott wave that are hard and fast rules that cannot be broken. The retrace for a wave 2 cannot drop below the start of wave 1. Wave 3 can never be the shortest wave. Those are immutable rules. But there are other things that are guidelines, and guidelines are a probability tool that we use that says most of the time in Elliott wave things are going to do this, but they aren't hard and fast rules. So one of the guidelines is that there's usually alternation between waves 4 and waves 2 in some form or another. So if we zoom out here, I think, well, let's just scroll back all the way over here so that we can see the wave 2, which I don't have all the data. We have to look on Garrett's chart that has all the data filled in. These points are placed based on the values in Garrett's chart, but the way that my data provider works, whenever I refresh the chart, it eliminates data on this chart prior to 1950. But these are based on the values that we got off of Garrett's charts for the larger supercycle wave 1 and wave 2. And this drop was a zigzag that had a very sharp drop for what the A wave, a bounce, and then a pretty muted wave C in relation to the size of the 1929 drop that filled out. But it was a sharp zigzag that was relatively quick, going from 1929 and bottoming in the early 1930s. So by looking at that, saying that we have a very sharp, deep, fast correction for that supercycle degree wave 2, then the couple of different ways that we can look for our fourth wave, our supercycle degree wave 4, to alternate. One way of alternating is it could take a whole lot longer. And you see this big red ABC that I have on my chart. I have it stretched out for the better part of 2 decades. Doesn't necessarily mean that it needs to be that long, but if you're looking at the fact that our supercycle wave 3 extended an extra 20 years beyond the 70-year bull market that R.N. Elliott predicted in the 1930s, it's entirely reasonable that we spend a lot of the time retracing, and particularly if we're going to try and alternate by not going as deep, then spreading out further in time is one way that things can alternate and not be as deep of a correction. So relatively speaking, on a fib, based on fib retrace, this that I have, the supercycle wave 4 here, all the way out in April, or January 2047, and again, this is not meant for accurate timing, comes in it's shy of only a 23.6% retrace. So in terms of Elliott wave as a wave 4, that is relatively shallow. Another guideline for alternation that we look at is that, you know, if we have a sharp zigzag, then a lot of times we can expect a wider flat and possibly even an expanded flat. That's where the B wave may try to make a nominal higher high even than the top of the wave 3. And so those are the three main things: the structure of the wave, where if it was a sharp zigzag, that it could be a flat; if it was a deep, harsh correction, that it could be a more shallow and one that takes a lot longer to fill out. So I think that if we have indeed topped in our primary wave 5 of the cycle wave 5 of the super cycle wave 3, then we're still just in the early stages of this larger move to the downside. And while we have to be mindful of the bigger risk that this represents, right now what we're still focusing on is really just the risk reward for the potential, you know, the risk of the potential C wave down, and then if we're looking at it as short opportunities, the risk reward basis versus the potential for further extension, and, you know, where supports are, where we would want to start legging into more potential short positions for this C wave down. And that is the intermediate degree C wave of this primary degree A wave inside the cycle A of the bigger correction. Now, this bigger wave 2 here, the green wave 2, is if on the off chance that this entire 5 waves up off of 2009 was really just a larger primary degree wave 1, and that this is an ABC for a larger primary wave 2, and that this cycle degree wave 5 is going to be even more extended. And so that's kind of like the coming of the Messiah extra bullish count, you know, that I'm looking at, that would just really extend this for many, many decades, even higher. I don't really think that's reliable right now. I think proportionally speaking, this is very substantial for an already extended 5th wave, but it is something to consider on the chart, especially when we're looking at also the potential of a pretty sizable B wave corrective bounce that could even try and make a nominal higher high from lows, you know, a couple years down the road after we get this bigger A, B, C out of the way. But if we've spent the entire, you know, most of 2022 into October heading down for this A wave, and then the bounce since October getting a corrective bounce as a B wave, we could spend an equally large amount of time heading down in a C wave, and then an even more amount of time in a bigger B wave bounce that could take the better part of a year, year and a half for a primary degree B wave. Although if it was really this green wave 2, this would be a parentheses A, B, and C. So that, you know, you're talking about a B wave, a cycle B wave rally that could take plenty of time, and that would have plenty of bullish opportunities in there, even if we were not sold on the potential that this was all of a more bullish wave 2. So then going back to the smaller degree, again, we have our completed 5 waves up, and then a 5 wave move to the downside as our intermediate degree A wave, and are filling out a corrective bounce into our normal fib resistance for B wave. And this is what we're going to focus on a little bit more at the smaller time frames from here. But we are expecting the potential break of support soon from ideally around 43.30 is my ideal for a top, 43.35 SPX. So we are going to look for 5 waves down and 3 waves up as a possible 1-2 start to the wave 1 of this C wave to the downside. And that's where we're going to zoom in and look at it a little bit more. But before we zoom in and look at this structure that allows for one more high, I wanted to talk about the couple of different, the 2 different alternate counts that I've posted for the structure inside this B wave. And it's a little bit academic, so we're going to kind of get into some Elliott wave weeds a little bit. But I think it's a really good teaching tool for kind of how we look at things. And at the end of the day, it doesn't really make a huge difference on the immediate expectations. But it is cool to look at how we look at those internal structures and the differences that it makes in terms of fibs. So one way of looking at it, we knew we had an ABC up for an A wave into the November high, and we were looking for a retrace as a B. And we got our ideal retrace into the December low and had lots of bullish setups there in stock waves, and we're looking higher in the market. We were getting some nice follow through in a C wave up off the December low until we failed to hold fourth wave support here in early February. And so that's when things started to look at different alternate counts that we needed to consider, where our C wave up from December low was getting interrupted. So one way that we were considering was counting this as an expanded flat, so still looking lower for more of a B wave, which indeed can count as we have it here on this chart, where this is an A higher high is a B wave, and then a C inside this B wave at the minor degree. And then off of that, we're getting a little bit more muted than we normally see, but 5 waves up as a C wave into that ideal resistance zone that we were targeting initially off December. The other way that I've shown is on this chart, and we're going to zoom in here a little bit. And so the difference here, this is zoomed in from the October low for that same 5 waves down as an A wave. But instead of counting this as an A, and then this is as the B, or this is A and the ABC expanded flat for the B wave, and then 5 waves up for a C wave, counting this as a WX, and then this is still the start off of December. We still have the moves up for what would have been the C wave, but it's turned into an ABC as a Y wave. And the reason why I like that is that we're getting fib extension that fits a lot better with this move itself. Closer to a, we already have a 100% extension for this C wave and are trying for a 123.6% extension, and are already at a 786 for the Y wave and are trying for closer to the 88.7, which isn't quite a 100% extension of what would have been the A, B, and a C wave, closer to the 4420, but we were still considering this 618 region as the B wave retrace, some pretty formidable resistance when we were looking up from the December lows. But when we zoom in, when we go over to our chart that we use for our smaller time frames, I still have on this chart, I still have the B wave counted here at the March low and that expanded flat for the ABC. And it's the same structure that we're looking at, whichever degree C wave we're looking for. So that's why, while you can look at that as two different versions of a count, at the end of the day, the structure here is the same, and we're looking for the same 4-5 to complete 5 waves up off of the March low. It's just a question of the Elliott wave notation for the degree. But this C wave is currently looking for the 4300 region as a 76.4% extension, and it would need to get all the way up to the 764 retrace to get a 100% extension. And the subwave structure that we have just does not look like that is a high probability at this time. So now zooming in on the structure off of this earlier May low, we were looking for an ABC move up as the circle wave 5 of the C wave. It's 1 degree smaller if we're dealing with the purple C of the Y wave. And we knew that that was going to be a 3-wave move up. There was a risk that a nominal higher high here in May over the top of the May 1st high could have been all of that circle wave 5, but we held support as an ABC retrace. That was right around a 618, I believe. Yep, right at the 618 retrace for that parentheses B wave, and have been filling out since then the measured move up, or actually more than a measured move. We're currently shy of a 123.6% extension, but holding a fourth here in the 4230 region and getting a 5th wave up towards the 4330s will take us to a 138.2% extension for this parentheses lowercase c inside our 5th. And that takes us just past our ideal resistance zone in this 4260 to low 4300s. So that is what we're looking for on the S&P. I did want to quickly take a look at the ES. At the smaller degree, it's mostly the same. I just think that you get a little bit more clarity with the subwave structure for Let's move that out of the way. Come on, be done thinking. All right, a little bit more clarity of the subwave structure. That including all of the data. So I think we're may get one more drop when we open at 6 or shortly thereafter to finish off this ending diagonal for the parentheses C inside what I think is still the micro A wave of more of an ABC structure for this fourth wave, ideally holding the 4250 to 4240 region in the ES, a little bit different than the same price levels that we're looking at on the S&P, just because of the contract rolls and things that give us a little bit different pricing for the ES futures, but looking for the same move up towards the 4340s to 4350 region to complete that final fifth wave. And of course, also on some of the other charts, I am counting it as the Y wave, the ABC of Y, and just keeping track of the fibs there. Comparing this to the, let's talk about the Nasdaq first. The Nasdaq just keeps getting little nominal extensions. At this point, it probably is better to count this a larger A and a shallow B wave, and then a C wave up, which allows for a little bit more of a 4 and a 5, and that can get up here closer to the 15K region. So that would have support, a pink fourth wave right down here. But it does not need to get one more high. It is possible to just count this as extension, and we can start to look for a possible break of some support, which would be 13,500 region would be the first real break of support level, and an initial 5 waves down and 3 waves up to give us a possible start to wave 1 of the C wave to the downside. Probably shouldn't be that low. Here we go, something like that. Then we can look at the Russell. The Russell may get a little bit more extension here. This is looking, when we were right about here, this looked good as 1, 2, 3, 4, 5 up for a C wave. Stretching to the 618 is fine, but it looks a little bit more like this is an A, B, and a C wave as this pink wave 3 in the A, B, C up for the E wave of a triangle. So that's moving this B wave, instead of this being 5 waves down for wave 1 and an ABC retrace is wave 2, from the B wave top here, that this is filling out more of the E wave of the triangle that we've been looking for. When we talked about both of the potentials for a move higher off of these lows, we said at the most bearish, it should get the wave 2 bounce, but we can also see it get more of this E wave, and that's what looks like it's playing out. Would like to see it hold the 1815 region as the fourth wave. Things jumping all over the place. As a fourth wave here, maybe even 1820s is even better. And then one more high up towards that 1950 to 1970s would be ideal, although the triangle line, if it's going to actually tag that, is just around 1992. And then we have our Dow chart, which I know a lot of you guys have questioned how I could possibly have the Dow counted as more bullish when everything else is looking like a top to a parentheses B wave is pretty imminent. And there's a couple of things on that. One, the Dow has lagged substantially, which does allow it to look more bullish. And maybe it does benefit from rotation and there's a flight to quality as everything else starts to sell off. And I could see that getting us at least a third of the C wave up towards the 35,400 region. I don't think that flight to quality is something that could get it the sustained move all the way up to new all-time highs. So something is going to give, and either this is going to make a valiant attempt and then ultimately failing, getting dragged down by the possible start to the C wave, Or maybe this is showing us that, things are not quite as bearish, and that even though everything looks like it's topping in a B wave, that we're going to get more extensions or just grinding and rounded out tops, while the Dow tries to follow through with a pattern for a C wave to a nominal higher high or an actual higher high in the fifth of the primary wave 5. It counts very, very different from the rest of the market, most notably that this was a more shallow correction into the September and October lows than everything else, that can still count as a fourth wave, even though it's at the deepest level that's reliable support for a fourth wave, where everything else very much looks like the primary wave 5 topped. This still allows for an attempt at one more high. But again, not only does it allow for that attempt, but we don't have as clear of a structure into a B wave top that we have on everything else, either here in December or February, where some things can count as a top, or getting the follow through already in the C wave that everything else has to count a B wave topping over here. But that's certainly a risk, and maybe it only needs nominally higher than the 35,230 level to move this B wave over and count it as maybe a WX and an A, B, C for a Y wave complete for all of that B wave. So I would not be married to a wave count here, even though that's the primary that I'm showing, as long as it's going to follow through. And rely on this getting to a new higher high. I've been showing this as saying, all right, look, if you're going to be bullish, even though we're getting so close to the top of this larger degree B wave, there are some things that make good arguments for heading higher, and this is one of them. All right, let's shift gears now, unless there are any questions about those indexes. Oh, before we go on, I do want to talk about our equal weight indexes. So this is the QQEW, is the equal weight Nasdaq. One of the reasons why I like that WXY count that we're talking about is because it fits so much better on the Nasdaq, and in particular on QQEW. Where this is the same, instead of the A and the B, this is a WX, and then instead of 5 waves up for a C wave, because we dropped under the low that we wanted to see hold as a fourth wave of C, to get 3, 4, and 5 complete for all of our B wave back here in March, we dropped down deeper than that and now are extending past it. So we're right now right at the original level that we wanted to see, the 100% extension off of the December low. But we should be able to hold more of this fourth wave here and get a fifth wave up to complete the C wave in this A, B, C of the Y wave, and possibly taking that closer to the 107 region. And then RSP is very similar. Actually, it's more similar to the Dow in that if it is bullish, we have a possible 1-2 start to a C wave up, even though that might not make a higher high. But there is this bigger risk that I pointed out earlier today in stock waves, that we can still count the B wave as topped back here in February, and a possible start to the move down, which might be the A and the B wave of wave 1 of an ending diagonal. And we didn't get any follow through off of this high that looked more like 5 waves up than a B wave. So that's when we started to consider that we had a wave 1 start to the C wave up, because we held, in particular, when we held the retrace here as the possible wave 2. But we have 5 waves up here, and this 5 waves up looks too big to be wave 1 of 3. So maybe it's an A wave of wave 3, even though this looked a little bit more like 5 waves up. But it can be a muted A, B, and the muted C wave for a wider flat of this B wave here, and a possible start to ABC for wave 1 to the downside. So certainly some risk, even though we have a bullish count that can be taking us higher. A lot of that hinges on holding corrective support right now, probably in the 142 region. below that, increased risk that it's going to break this 138.80 low. And if that 138.80 low breaks, buckle up. All right, now let's move on to the metals. Zoom out a little bit here. Actually, let's go to the bigger chart. There we go. So gold counting as an ABC up for wave 1 of an ending diagonal for the primary wave 5. And then after we have our pretty shallow, more shallow than normal, wave 2 for, actually it wasn't shallow, it was a perfect fib level for wave 2. But usually we see at least a wider flat, if not a deeper retrace in a diagonal. But we have a strong 5-wave move up for an A wave. And now we have a perfect retrace as a B wave. We're struggling a little bit to get started in the C of wave 3, which should be targeting the 2300 region. So when we zoom in on the structure here, one, we have a little bit of struggles off of this low, but I don't think we can really count off of this low in gold futures because there was a contract roll here, and we actually made a lower low here on May 30th, and are probably actually testing that. And then actually GLD made a nominally lower low here on June 5th, and we're very close to testing that already. So still in support for this B wave, but have not given any clear signs yet that it's bottomed. So I may look for this to just actually get to the 1930s again on the June contract, or maybe this is July contract now. Oh, no, August. Is that right? Yes, we're on August now. So this is on the August contract. So it might try and retap this 1933 level just so that it looks better on all time frames and on all contracts. So that would move this 3-4 over to here as the 4th, and this is A, B, and C for one more low as the 5th. Let me just move that now. I don't know if you need to move the 3 over here. I think you can count it as an expanded flat there. So tapping to one more low, and it could even, I mean, it doesn't necessarily have to really break and hit all the way down to 1933 for it to count better this way. And then we can just look for a new 5 waves up and 3 waves back as the 1-2 start to our C wave of 3. Silver is pretty similar at least as far as the diagonal is concerned, off of the 2022 low. We're counting that as an ABC up for wave 1, but it can't really be a wave 2 because you can't have a 3rd wave as a diagonal. So at the primary degree, it's something different. It's not the same primary degree wave 5, and it's certainly not a 3rd, but in terms of counting like gold, we have the same intermediate 1-2 and an A-B start to the 3rd, and are working on trying to get this wave 1 of C started. And this C of 3 targets the 3250 region is my ideal. Moving over to GDX and the miners. Now, if I haven't mentioned it before, is probably an excellent time to check out the Metals, Miners, and Agriculture Service because we have a lot of very, very bullish looking individual mining charts, which have, many of them have projections for the rest of this 3rd well over 100%, whereas GDX is looking at 40% and 70% gains for the rest of this 3rd inside a C wave of a larger primary wave 3. So lots of great setups, but not all of them look as great. So you got to kind of pick through. I mean, a lot of things have a similar structure, but they're not all individual miners are equal. But a great 1-2 start. GDXJ looks very similar. So looking for this 30 region to hold as the 1-2 and get us a nice 5 waves up into the 36 region as the wave 1 inside the heart of the 3rd of our C wave in the larger primary degree move off of the 2020 lows. Next, we should take a look at oil. Oil, I'm still short-term bearish. As long as this structure off of the May low looks corrective, which it does, it looks like an ABC flat into a 618 retrace of an initial move down from the April high. So I'm going to continue to look for this to try and make another low down here into the mid to low 50s. So that could be an A, B, C move as a third, and then get a big bounce as a fourth, and then one more low after that. But my preference is that this is a B wave of a Y, and we get 1, 2, 3, 4, and 5 to complete all of that move very shortly. Natural gas continues to try and be bullish off of a potential very extreme low, but really struggling to maintain any kind of clear constructive Elliott wave pattern. I still have this as a possible wave 4, but I'm just following the diagonal structure of the possible upside with the potential that if that does complete as a leading diagonal, then from there, if we hold a corrective retrace to a higher low, then we could be more reliably long-term bullish. Rob says, what did I mean earlier today when I said GDX was getting affected by bonds? Well, it's a good time for us to switch over and take a look at the U.S. Treasuries. So U.S. Treasuries looked great as an initial move off of this May 26 low as a 1-2 start. This was a 618 retrace, and we were looking for a start to a 3 of wave 1 of this larger C wave. But we only got 3 waves up, and they started to falter, and they couldn't hold ideal support right here in the high 127s. So dropping down here forced this wider flat off of the earlier June high. So that's what GDX kind of did on the smaller time frame. Also today is that this move up off of from the June high, we had enough for this to be all of the wave 2, but this only 3 waves up turned out to just be an X wave in a wider flat coming down to a 618 retrace at the smaller degree. So very similar structure between the two of those. I'm not arguing for any kind of correlation. It just happens to be at the moment they are in sync for the same 1-2 start to a lowercase parentheses wave 1 of a circle lowercase wave move to the upside swing. In treasuries, though, that is a C wave, and in the minors, it is the third of a third. So I am much more bullish minors than on treasuries, but there still is a very nice bullish setup off of that low. At the very least, I think that this should be an A and a B, and we get a C wave up towards the 131.15 region, testing this top Bollinger Band, and that would be an A, B, and then we get a wider flat as a C wave in an even wider version of this B. But my preference would be that this kind of follows in tandem with the minors for a short period of time to get more of this wave 1 and wave 2, and then filling out even more of the C wave as well. And TLT, I think, is very similar. I put a lot more effort into the smaller degree structure of the big 30-year treasury bond, because I think that that is really what is wagging the dog. So this could be the wider flat here, struggling to hold a nominal higher low, whereas the 30-year treasury is just at the 764, which is fine. What else? So I know Avi focuses more on TLT. I haven't looked at his chart recently to see if it is going to, I mean, if this is the wider A wave and you're not going to base it on the same WXY that fits better with the 30-year bond futures, then this is relying on an A, B, C for a Y wave. So if this is an A and a B wave, then this can be 1, 2, 3, 4, and you need a fifth wave of the C into the 98 region. But that's not needed on the 30-year bond, and certainly not needed on the 10-year bond. So a little bit of discrepancy between the larger instruments that TLT is meant to track and TLT itself. So, pick your poison there in terms of what makes more sense for you to pay more attention to. Obviously, if you're trading TLT, then you do want to pay attention to TLT. If you just are more concerned about the overall movement of bonds, then maybe pay a little bit more attention to the 30-year Treasury. All right, what are we missing? We should probably take a look at the dollar. I haven't looked at the dollar in a while. Got more extension in the possible wave 2 bounce up to a 764 retrace, because we got a little bit more of the third, and then we got a more shallow fourth wave, but then we can count 5 waves up here in a fifth. So ideally, that is all of the wave 2, but this looks like a little bit more bullish structure here off of that low. So if this is going to hold, there we go. That's horizontal. Oops, I want a green dashed line. So if that's going to hold, that is 103.31, then this can still be our Alt B wave. That we faded out because it really looked like 5 waves down. But despite this looking like 5 waves down, this could still have been A and a B wave and 1, 2, 3, 4, and trying for a fifth wave up, maybe only heading to about here now. So this can be a 1-2 start to a fifth in that C wave after all. But I think if that's the case, it has to hold this 103.60 level. You break under 103.50s, and you're probably going to break under 103.30s, and then you probably, maybe there's another chance that an alt wave 4 can hold 102.70s and still try for a fifth, but I think the bigger risk is that this is all of a 1-2 start to a C wave down. Yeah, we can look at EM. EM looks a lot like RSP, where we have a huge risk that all of the B wave topped here in January or February as we're looking at RSP. We have a possible 5 wave move to the downside, but it was too small to be all of wave 1 and too big to be just wave 1 of 1. So this could be the A wave of wave 1 in a diagonal, but we didn't hold the resistance that we needed to start that C wave. But at this point, it can be just a wider, more complex flat as the B wave here. So that is a risk, although it doesn't look as good as a possible flat for a B wave as the RSP does. So the more bullish alternative is that this is the same purple A and B, similar to what we're looking at on the Dow, and that this is a 1, and this is wave 2, and this is a 1-2 start to the 3, and then we're going to fill out more of this move to the upside. So this needs let's put this here and flip it to green. So it has to hold this low under this, and it can be really bad news for a while. But off of that low, it does look like we have a potential 1-2. To this third of the purple C wave. So we can get a little bit more of an ABC down for wave 2 if we zoom in on that structure. We see our ideal fib zone takes us a little bit lower to 39.14 and down to 38.66 as the normal fib retrace. So this might be an A wave. We get more of a B wave bounce tomorrow and then get a C wave down into Friday or Monday. and then try and turn up from there in more of this third. And if we snap these, I don't want to move my B wave out of the way yet, but this will give us pretty close to our fibs for that third. Yeah, so we got to a 618, so we should at least get to the 42 region for this wave 3 of 3, if not closer to 4260, and then at least to the 4350, if not closer to 44 for the 5 of wave 3, as long as we're going to hold support as a wave 2. That's a good question. So Rob says on EM, I mentioned that this was too small to be wave 1 of the C wave off of this January high, but too big to be wave 1 of 1. So we know that most C waves tend to a 100% fib extension. So that means usually we want our wave 1 to head to about the 382, sometimes the 0.50. So if we stop shy of that, then it's usually not all of the wave 1. But here we got pretty close. We got past a little bit past to 236. So if this was 1 of this wave 1, then we get 1, 2, 3, 4, 5. That takes us all the way down closer to a 618, and that's too big to be this degree wave 1 inside the C wave. So that's when Garrett and I will look at something like that and say, all right, we have what looks like 5 waves down, but it's too small. So that's when we'll say, all right, maybe that's an A and a B wave inside the start of a diagonal, because that gives you only an A, B, C instead of 5 waves for wave 1. They can get you closer to that ideal target region and not be too big. But from right now, we got over resistance that needed to hold here for any immediate downside. So we can fade this to gray like we did on our RSP chart. And we are following this purple potential, even though this looked more like an ABC here. We could force that into 5 waves up for the wave 1. And this definitely looks like 5 waves up here as a 1-2 start to the third. And then that just takes our B wave, instead of topping shy of the 50%, that takes us back up to 47 region here is a 618. So again, potential for more sustained upside, but that's kind of at odds with where we are already in the topping of this region in the S&P. So is it a flight to quality that people look at, this as something that's late to bloom, or did this just miss the window, and when everything else tops, it forces this under support, and then we kiss this potential goodbye. Anything else that we normally cover in our beginner circle webinars that I missed? I don't think there is. There's some other metals that we look at in the metals service that look great, as well as some commodities. But I think that's going to do it for today. So I will get this uploaded for you guys, and I will see you the next time in a few weeks. Have a great evening.